Hi, from previous videos we have seen the payoffs of call and put options from both long and short positions. In reality, investors are not just limited to one type of options. They usually combine different options and achieve whatever investment goals they have, whether it's speculation or it's just risk hedging. One of these combinations is called a straddle. And let's take a look how a straddle is constructed. It's simply combining one call option and one put option at the same strike price, and we go long in both options. Let's take a look at the payoff for these options. So we have already seen that for a call option, you will never exercise it if the underlying price, or the ST, is lower than your strike price. So if ST is lower than K, then your payoff is 0. So we're talking about the intrinsic payoff, not considering the price of the call option yet. Okay, and then if the strike price is, if the stock price or the underlying price is higher than the strike price, then you exercise it. So the payoff would be ST minus K. And the put option behaves exactly the opposite. So if the ST is less than K, or your underlying price is less than your strike price, then you will exercise it and you will have a payoff of K minus ST. And if it's the other way around, you will never exercise it, so you have a payoff of 0. Okay, so in this case, you would have an overall payoff of K minus ST and ST minus K. So let's factor in the prices of both options, and let's draw the net payoffs on the graph. Okay, so for the call option here, we have seen the payoff diagram before. So it's basically something like this. Okay, so with just one unit of this call option, then we'll have a 45-degree line, and this will be our strike price. Okay, and let's draw the put options payoff as well. Okay, so we'll draw it side by side, and so this will be K over here, and it's going to cost us some money, so we'll extend it a little bit here. All right, so let's combine these two together and see what we would get for the straddle. So this will be the overall payoff of a straddle. Okay, over here. So with the same strike price K over here, and let's take a look here. Before K, or if the ST is lower than K, the call option will give us nothing, but then we'll have the payoff of this put option. And after K, our call option will start paying us off, but then the put option is going to be worth nothing. So basically we're combining just this part and this part together. And then remember, we're buying both of them, so the cost will be combined as well. So just to illustrate this, we can kind of move this thing below here. Okay, and then it goes back up. So the overall payoff is going to be this V-shaped payoff diagram. So why are we doing this, and why do we use straddles? As we can see here, if the actual price for the underlying asset is around K, we'll always make a loss. There will not be a profit. But if the price is actually moving very far from our strike price K, we can make a profit in both ways. So this is essentially betting on the volatility of your underlying asset, and we're sort of betting on the underlying asset being very volatile. So if the price of our underlying asset is kind of stable around your strike price, then we'll make a loss. But if it's very extreme, we will make a profit, whether it's increasing in a very extreme way or decreasing in a very extreme way. And we can make a profit both ways, as long as the price movement is kind of extreme. Okay, so this is one of the examples that we can use to illustrate the combinations of options, and this is called a straddle. Okay, and you should be able to analyze the payoffs, and by looking at the individual components and draw a diagram like this one. Okay, and in the next video we'll demonstrate a different combination of the options. I'll see you there.